What we heard from Toll is they said orders, I think, were down about 45% year on year for August, the first 3 weeks of August, which is certainly not a great number, but better than the negative 60% they saw for the full July quarter. In terms of what we're seeing on prices rolling back, we haven't seen that much in terms of outright discounting. I think it's been very selective so far. It seems like the incentives are still focused mainly on rate buy downs and mortgage rate locks, helping people afford those homes.
You make the point that Toll is really it's a luxury price point. It's a different business than the rest of your builder coverage. So what kind of lessons can we extrapolate to the broader universe?
So I think what we've heard from D.R. Horton, and I think this applies to Meritage and Century, which are two other names we're outperform rated on, is that the buyer who has a need, family growing, new family, et cetera, that needs-based buyer, even with the higher mortgage rates and the higher rents, they're still out hunting for shelter. And so we would focus on those three names first. But then as we think about some of the other more luxury higher-end names, we'll see what happens with mortgage rates. Maybe this pullback that we've seen from 6%. Plus, and Toll always says that they're a stock market driven company. So with a little bit of rebound in the market and lower rates, maybe that's what's going to benefit Toll and some of the higher end names.
Right. Yeah. You say you're basically long-term bullish on single family and multifamily. I wonder part of that, I guess, is the structural demand being structurally underhoused as far out as we can see. But how much of it is tied to the idea that maybe we've seen sort of a medium-term top in mortgage rates?
We'll see. We don't have a formal rate forecast, but I think when you look at occupancy for multifamily sitting at 95%, occupancy for single-family rentals sitting at 97%, and the jobs picture holding up, I think that you put all that together, that's kind of the underpinning of our long-term bullish thesis on the group. Certainly keeping a close watch on jobs, because jobs lead us into recovery, and they also lead us into the downside when the jobs start to disappear. But so far, it seems like we're seeing good news on the jobs front, so not worried there. I think the other thing longer term, and especially what's different this time versus the GFC, I think this institutional demand for single family for rent, that's a new source of revenue and earnings for the home builders that we didn't have. We had around in small measure, but not to the extent that we're seeing now. So even if the consumer may pull back a little bit, we expect that SFR category to step in and maybe pick up some of the slack from the consumer.
Yeah, that's interesting. I saw some stats in the last couple of weeks about the percentage of homes sold in which the buyer really has no intention of living there at all. I mean, it's a nice source of demand, but optically, politically, it raises some eyebrows.
Yeah, but I think if you are that needs-based buyer who needs shelter, and you can qualify for the rental, and it puts you in the better school district, gives you the better amenity, gives you that single-family detached living you're looking for. I think that's even though there's certainly been some political heat around it, I think that is a viable option that people are going to take advantage of. It's especially with multifamily rents moving up almost and more at this point than what we've seen from single-family home price appreciation. I think that SFR option is one that consumers and the home builders are going to take advantage of.
Hey, finally, Jay, I asked Diana about supply out of the new home data yesterday, 10.8, 10.9 months. Some argue that every time it exceeds 9 months, it's a recessionary call. Can we make those kinds of extrapolations now?
That seems like a really high number relative to what we've seen in our local market data, which is still running around 2 to 3 months. And you look at the NAR's number, I think they were at 3.5 months for existing homes on the market. Not sure that we can make a recessionary call for that. That number just seems unnaturally high to me, given what if you compare it to the other inventory stats that we have out there. We'll see. I think for the builders, one of the things that we've heard from Toll today and from other builders is that it's still there are random supply chain issues, both on land development as well as getting the homes built. So I think the inventory surge that we saw during the GFC and during the back half of 18 Can't rule it out this time around, but I think it's harder for the builders to overbuild, just given what we've seen with supply chain headwinds and some things like that.
Right. Fascinating. It's got to be a hard market to read right now, and hard to match it with the analogs from the past. Jay, great stuff. Appreciate it very much. Thank you.
Thank you.
Jay McCanless.